Welcome to The Explainer. Today, we're going to break down the kind of complex world of corporate risk and accounting. But we're going to do it using a concept that, believe it or not, you're already an expert in, and that's your own financial future.
All right, let's just jump right in. I want you to think for a sec. If you had to name your single most valuable asset, what would pop into your head? Your house, maybe? Your car? That savings account you've been building up? Okay, so here's the interesting part. For most of us, especially when we're earlier in our careers, the real answer is something you probably wouldn't even think to list. It's something called human capital.
So what is that exactly? Well, put simply, your human capital is just all the money you're expected to make for the rest of your working life. And when you're young, that potential to earn, it's huge. It absolutely dwarfs what you have in the bank. It's like the bedrock of your entire financial world.
So yeah, this hidden wealth, your ability to just get up and go to work every day, that is by far your most valuable asset. But just like any asset, it's got to be protected.
Think about it. If your future earnings are an asset, that means they're also at risk. And if it's your biggest asset, well, it's probably worth protecting, right?
I mean, what's the biggest risk here? It's the possibility that something happens that just stops you from earning that income. An illness, an injury, something that could pretty much wipe out this asset completely.
And the thing is, you probably already managed this risk without even realizing it. You're probably not thinking about it in these terms, but this is exactly what things like disability or life insurance are for. It's a financial tool you use to protect, or to use the finance term, to hedge the value of your future paychecks.
Okay, so now let's take that same idea and just scale it way up. Because companies, they operate on the exact same principle, just on a much, much bigger scale.
And this really lays it all out, doesn't it? Just like you have your future earnings, a company has its future cash flows. And just like you've got personal risks, a company has these huge financial risks to worry about. So naturally, they also need some kind of insurance, a hedge, to protect their financial future. But we're not talking about personal health risks here. For companies, it's all about major financial risks, like credit risk. What if your customers just don't pay their bills? Or market risk. I mean, imagine you're a company that relies on imported parts. A sudden swing in currency rates could totally wreck your profits, literally overnight.
So, how in the world does a company buy insurance against something so abstract like a sudden spike in interest rates? Yeah, you can't exactly call up your local agent for a quote on that one.
Well, they do it with a really sophisticated strategy called hedging, and they often use these financial tools called derivatives. Now, don't let the word scare you. Just think of a derivative as a contract whose value is derived from something else, like an interest rate or a currency. These are the tools companies use to build that protective financial wall, to create some predictability in what is a very, very uncertain world.
But okay, when a company does all this fancy stuff, how do they actually show it to the public? That's where something called hedge accounting comes in. Really, it's just the official rulebook for how companies are allowed to report these protective financial strategies to investors, people like you and me.
Now, it's not a free-for-all. To use this special kind of accounting, companies can't just do whatever they feel like. They have to follow some really strict rules to prove that their hedge is actually doing what it's supposed to do, reducing risk, and not just, gambling.
So here's the key. Regulators, under this big standard called IFRS 9, have a super strict checklist. A company has to formally document everything right from the start. They've got to prove there's a real economic connection between the risk and the hedge. And they have to make sure other factors, like credit risk, aren't messing the whole thing up.
Okay, this is where it gets a little bit technical, but hang in there with me, because this is pretty cool. To get how this works on the books, I want you to think about sorting your recycling. Right? You don't just toss a plastic bottle into the regular garbage. No, you put it in a separate bin now so that it can be processed and matched up with the right stuff later on.
So, this exact process in hedge accounting is called recycling OCI. OCI stands for Other Comprehensive Income. I want you to think of OCI as that special recycling bin, but on a company's financial statements. Any gains or losses from the hedge, they go into this bin first. This keeps them separate from the main profits for the quarter. Then, and this is the important part, only when the actual risk hits the books, let's say that currency rate finally changes, then the company recycles that gain or loss out of the bin and moves it to the main income statement. What this does is it makes sure the pain from the risk and the gain from the hedge show up at the exact same time. It creates this really smooth, accurate picture of what's actually going on.
I know that sounds super complicated. So why on earth should you, whether you're an investor or just a curious person, care about these really detailed accounting rules?
Because it lets you see the real story behind the numbers. Seriously. Without hedge accounting, a company's profits could just swing all over the place because of market craziness, even if they're running a totally stable business. This special accounting, it shows you how a company is actually thinking strategically about what's coming down the road.
So at the end of the day, what hedge accounting really does is give you a much truer, much smoother picture of how a company is actually performing. It lets you peek behind the curtain and see their plan for managing risk. It turns what could be a really messy internal strategy into a clear public story that says, hey, we're being careful, we're stable.
So the next time you find yourself looking at a company's annual report, don't just stare at the big numbers. Dig a little deeper. Look for the notes on hedging and ask yourself, what are these guys actually worried about? And what story is their strategy telling you about how they're getting ready for the future?